What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is May 5th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to talk a little bit about the bigger picture and discuss not only why Bitcoin, as well as gold and silver, are going to react positively in an environment of excessive monetary policy from central banks, but on the topic of central banks and excessive monetary policy, why the Fed, the ECB, the Bank of Japan, and the People's Bank of China, as well as other global central banks across the world, have the wrong idea about fixing the issue, and why it's not going to be helping you out, but rather asset markets, otherwise known as accredited investors who already have enough money in their pockets as is. Alright, so we're going to be talking about all this and more as we go throughout the video right after our quick sponsor. Our sponsor for today's episode is Bitpanda Pro. Bitpanda Pro is the secure European exchange for crypto to fiat markets. Bitpanda has been offering secure, straightforward, and easy access to the cryptocurrency market in Europe for over 5 years and wants to offer the same service to more experienced traders, users using trading bots, and other advanced clients like cryptocurrency businesses and institutional investors. With the steady addition of more and more crypto to fiat trading pairs, Bitpanda Pro has made itself a convenient, secure, and trustworthy exchange to onboard or cash out easily. Check out the link down below in the description to learn more. Alright, so let's go ahead and kick this off by just taking a quick look over cryptocurrency markets. Over the last 24 hours, we've got a lot of plays across the board. Unibright up 23%, Energy up 9%, and a few of our other plays doing well, such as Kyber Network up 5%, and down the list as well, Chainlink and Ravencoin as well, doing quite nicely. But the broader market right now, generally in a no-trend scenario, I would say, again, starting to push up towards the upside here, more players in the green. Nonetheless, though, most of the market here holding relatively neutral territory, as Bitcoin has slowly been setting higher significant lows here. As we can see on the 4-hour chart, we started to set a higher level here on the wedge. We actually had a short breakout here for a little while. If you really want to consider it a breakout, it was just about $100 above the line of resistance here. And again, I think we're going to come back up here. Again, we're starting to see that price is applying pressure to the line of resistance. So again, the bulls are in favor right now in the short term. But again, hiding our drawings here, just going ahead and focusing on the daily, things holding up quite nicely. We're not even getting a real consolidation period like we had back here in early April. We're just simply holding sideways, again, on very thin volume, meaning that right now it seems like, if anything, buyers are winning out in this case, as we're seeing a lot of anticipation coming into the halving event. And who can really blame them? It's not only the halving event that is a definitely exciting event here. It's actually less than a week away. We've got it here in the next coming days, so I can't wait to live stream it and join in that event with you all. But we also have the macro environment. And speaking of that macro environment, I want to dive a little bit into a few key things here that I think really kind of shape the current problem and flaws in regards to how central banks are responding to everything that's been going on with the recession that we're currently living in globally, and what might very well become a depression due to the malpractice of central banks. I want to go ahead and kick off this discussion with a really interesting indicator. And in fact, it's used by Warren Buffett and various other people across the world. They call it the Buffett Valuation Indicator. It's a pretty simple ratio between two very important things. And seeing the dichotomy between these two elements really showcases just how far we've gone in regards to propping up asset markets, stocks, housing prices, other forms of assets and financial instruments versus the underlying economy. You know, the economy that, if it were to grow, usually sees higher wages for you, better employee benefits, you know, basically a better standard of living for the average citizen, right? The thing that we probably all see as the real economy and the thing that we all care about at the end of the day, right? Because it has to do with our salaries and our well-being. Well, if we take a look here at the Buffett Valuation Indicator, we can see a very interesting dichotomy over the last few decades, where we started to see more priority in this case, or a higher level of valuation for asset markets comparative to the real-world economy, right? Now, of course, bear in mind, the real-world economy and most likely, especially overall asset markets, have generally both grown in the long term, right? As you have more of a population, as you have more productivity and advancements in technology, yes, things on average, of course, over the last few decades have generally gotten better, both not only in asset markets, but in the real-world economy. But the thing I want to emphasize here is the separation between what we saw back here during the 1950s to 1975 versus what we're seeing here from the 90s to the modern world. And that is the valuation captured in asset markets versus what's really happening in the underlying economy. We can see here within this ratio, as the levels generally rise higher here, we've gone from an environment where it was normal back here in 1954, in 1983 or 1982, where it was common for equity markets to make up 32.2% of total GDP. So for every dollar in GDP, we had about 32 cents in valuation for the underlying assets of that overall economy in this case, right? So again, equity is making up a smaller fraction of GDP. Well, now we've gotten into an interesting dichotomy where asset markets, for every $1.50 of equities or other types of assets across the world, in this case corporate equities more specifically in this ratio, are now valued at 1.5 times any dollar of actual economic GDP. So real economic activity. And this showcases what we've prioritized in this case. We have prioritized stimulating artificial asset markets rather than actually stimulating or driving real growth long term to the underlying economy. And what do you think has caused this? What do you think has been the changing factor from back here where we were at a much healthier ratio here between these kind of lower levels and much more medium levels here below 100% for corporate equities to GDP? What do you think changed in this time period? It was our response to economic downturns. It was the response of central banks. And again, sadly, this is something that's a bit out of our control, guys. I mean, we can kind of talk about changing our legislative body and stuff, or ending the Fed and things like that. But the central banks of the world run the global economy, and ever since back in 2008, they have been on a printing binge. We can see here that just like back in the early 90s, where again we did have the Fed stimulating markets in this case, they lowered interest rates, leading capital creation to being very cheap. That's one other element here. But we can see the direct printing of money being a huge stimulatory factor in order to relieve economies during times of stress. Now, bear in mind, not so much economies, but asset markets. That's the difference, okay? So I don't mean to misspeak there. I accidentally did a little bit. So not economies, right? The Fed will label it as helping global economies, relieving capital strains in markets. And that's very true. They are doing that. They're providing more dollars, more supply. Therefore, dollar liquidity is much more fluid, right? But where is that dollar liquidity flowing? Where are those dollars going at the end of the day? To put it very simple, are they going out to you in the form of, a stimulus check? Are they going out to you in the form of, for example, a cheap, low interest rate loan to get your business through these tough times where you can pay the Fed back at a later date? Are they doing something to help you out? Or maybe are they helping you to refinance your home so your mortgage rate and the interest on it is less rather than what you would have had to pay before? No, it's not any of these things, right? The federal government is the one, alongside the Treasury, issuing the new checks in this case for you. The Fed has been operating in much more of an institutional way. They've been working alongside corporate banks, hedge funds, bailing out risky speculators. And we can see this when we take a look at some of the hardcore data here. I was looking at Samantha DeLuca's Twitter page, and she had retweeted a really awesome set of charts here. And this is the one that really stuck out to me. So we can see here that we have the global GDP weighted policy rate. So in this case, again, we're seeing here that the general cost to capital, right, the general expenditure in order for you to borrow is going down quite dramatically. We can see that it dropped pretty extensively back here in 2008 when the Fed funds rate was dropping. And we can see here that now we've reached, generally speaking, as we weight in GDP, the lowest levels we've seen probably in history, or at least in the last couple of decades. So credit is extremely cheap, but here's the catch, right? Many of you might not be feeling this overt abundance of credit, this overt amount of printing and cheap liquidity. No, because see, at the end of the day, global lending standards are increasing during this time period. As we had talked about back a couple of weeks ago, if you were to apply for a mortgage right now to buy a home, I know many people, including myself, who are looking at this time period as prices are probably declining, to possibly pick up a property sometime soon. Start looking at basically, getting my own piece of land or getting my own home. Well, now the standards, since back here in 2018, where they're actually quite simple and quite easy and light, back like they were back in 2005, no, they're getting more strict now. And this is going to basically be a squeeze on not only the broader housing market, but it's going to be difficult for you and I. We can't get access to this liquidity. And this is the problem here. I'm not going to say at the end of the day, right? I think in this case, banks setting higher standards is kind of expected. It's understandable here in an environment where people are much more credit tight. But the dilemma here that I see is we are not only in an environment where banks are tightening these things, tightening these restrictions. I think that's completely fine. They should be freely able to do what they want to do in this case, right? I'm not arguing that. The problem I have is that central banks are making the argument that at the end of the day, they are printing money to get the underlying economy going. They're not. This money's flowing to hedge funds. It's flowing to people who own toxic assets like mortgage-backed securities. They're going to people who are owning treasuries. The vast majority of Americans are not going in and out and trading treasuries. They're holding treasuries, or they don't own any or any other government bonds. To put it simple, as I've talked about before, the bottom half of America owns 0.5% of all assets. That's properties, that's treasuries, bonds, stocks, other forms of assets like gold and silver. This is not working in the interest of everyday people. If the Fed decided in this case that they wanted to debase the monetary supply and start printing money and, change the rules, they've said supposedly they can't do it for some godforsaken reason. There's no reason to it, guys. They just simply don't want to print money like the federal government is doing to directly, provide money to consumers. They'd rather provide it to financial markets because they've built a massive bubble. And along with that as well, we have to be a little bit cynical here, guys. I don't think I'm a conspiracy theorist to think that for the last few decades, we haven't just come to the conclusion that this doesn't work. And in reality, central banks are just probably supporting the financial cabal that makes up the global economy and has sucked up the vast majority of wealth. Couldn't possibly be that. It's like, that's not like crazy, I think, in the slightest. I think that's just a very rational argument here. And the thing is, the Fed's doing it alongside other central banks because they can get away with it. It's proven here. The number just gets larger and larger. And no matter where the Fed takes this, the more they print, in this case, we just have to simply look at where they're directing the capital. As we've seen central bank balance sheets rise, I want you to ask a simple question. Have you seen your incomes doing better in the sense of your purchasing power? Like, are you able to buy more at the store? Are you able to pay your rent or your mortgage? These are the kind of questions you should be asking yourself. Are your healthcare costs, your education costs going down? They're probably not. And again, I think there's a lot of other reasons as to why, things suck on a day-to-day basis. But this right here is the ultimate driver. Ever since we broke off of the gold standard in the United States, again, I'm not even a full-on again, there's all kinds of different people and stuff. You have Austrian economists in this case, and you also have as well Keynesians. Guys, I'm a very kind of moderate. I like to explore different monetary policies, but I will say the argument here at the end of the day is that central banks have had a failed experiment of Keynesian economics. They've printed excessive amounts of money. And again, it would be interesting to see what that printing would do if it was directed at everyday consumers who are going to circulate that capital in the real world economy and expend it on things, who aren't investing in assets. But we're not seeing that. What we're seeing is a very, very twisted approach to monetary policy that benefits a very select few who own assets. And the sick argument that the Fed makes that by asset valuations going up and people utilizing those assets in order to get credit or loans really doesn't benefit everyday people. A direct benefit from that comes to those same exact people who already have inflated wealth from the assets that they own. This is not a healthy way to re-stimulate markets and to get people back to work. Printing money will not get us out of the same problem that we dug ourselves into. And that's not talking about COVID-19. It's talking about the broader problem that we have built up time and time again that has further destroyed the middle class, not here just in the United States, but across the world. So, anyways, I rambled on a bit there, guys. I hope you all enjoyed these charts here that we went through. I hope you all enjoyed, again, the discussion that we've had for Bitcoin here. This is the reason I'm positive here in regards to Bitcoin and other digital assets that have limited or finite supplies. We've got to see the value here in the bigger picture. And it's not here by looking at, per se the 5-minute chart or even the hourly chart in Bitcoin. It's the daily, it's the weekly, taking a look at the longer term trend here. And it's going to be in the next couple of months significant to see how the cycle has played out here, how we're stepping into the next cycle, what levels Bitcoin can go to as we go through that halving event, and as the macro picture grows even more worrisome with negative interest rates and excessive money printing. All right. Anyways, hope you all are having a great day wherever you are. If you all like this video, please drop a like. I always appreciate it. It helps out the channel. And along with that as well, if you haven't already, if you're new, definitely consider subscribing, guys. Always love having new people on to the family here at DataDash, or in the family here at DataDash, or on the channel. We're trying to find a way to really put that, but to me, guys, you guys are all family to me. I appreciate all of you guys who, even if you're just watching the channel, or if you support the channel through our newsletter or through a variety of our links down below in the description, it means a lot to me. But all in all, guys, have a great day wherever you are, and I'll see you all in the next video. Stay tuned.